Spring 1920. The dust of the First World War had barely settled over Europe, but a new, silent war had already begun. The French Prime Minister, Georges Clemenceau, realized a terrifying truth during the global conflict. A drop of oil was worth a drop of blood, and France had absolutely no domestic oil reserves. While the Americans and the British were rapidly carving up the Middle East, France was entirely dependent on foreign trusts. To ensure the survival of the nation, the French government demanded the confiscated German shares of the Turkish Petroleum Company as war reparations. With those assets in hand, a completely new entity was forged by state decree in 1924, originally called the Compagnie Française de Pétrole. Today, we know this sprawling, globe-spanning leviathan as TotalEnergies. It represents a ruthless, transformative move that shocked the financial establishment and forever altered the balance of power in global energy. But in a modern world characterized by brutal windfall taxes, volatile geopolitical alliances, and an aggressive push toward decarbonization, is this French titan a bloated relic of European bureaucracy, or is it the most intelligently diversified cash machine on the continent? Today, we strip away the public relations campaigns. We forensically dissect decades of financial data, and we determine if TotalEnergies truly belongs in an elite dividend growth portfolio. Welcome to the archive. The evolution of TotalEnergies is a masterclass in aggressive expansion and calculated diplomacy. In its early decades, the company was jokingly referred to as the only major oil firm without its own oil. They had to outmaneuver the established Anglo-American competitors, like Standard Oil and Anglo-Persian, by going where others would not or could not go. They built immense diplomatic capital in Africa and the Middle East, securing deep-water offshore drilling rights and vast territorial concessions. But the true turning point, the moment this company morphed from a regional player into a global supermajor, occurred at the dawn of the 21st century. The management team orchestrated a spectacular series of consolidations. First, they absorbed the Belgian petroleum giant Petrofina. Then, in a move of sheer corporate aggression, they launched a hostile takeover of their massive French rival, Elf Aquitaine. Overnight, Total became the fourth largest publicly traded energy company in the world. While competitors like ExxonMobil remained rigidly tethered to traditional crude oil extraction, Total began executing a long-term strategic pivot. Over the last decade, they systematically rebranded and restructured, aggressively expanding their footprint across the entire energy value chain. They recognized early that the future was not a monopoly of crude, but a complex matrix of chilled natural gas, electrons, and biofuels. To understand the sheer scale of this enterprise, we must deconstruct its operational engine. In its most recent fiscal reporting, TotalEnergies generated a staggering $218 billion in total annual revenue. This revenue is driven by four highly integrated pillars. The refining and chemicals combined with the marketing and services segments represent their downstream operations, bringing in $138 billion, which constitutes 63% of total revenue. This is the industrial machinery that turns raw hydrocarbons into consumer products and moves them through a vast global retail network. The upstream exploration and production segment generates $45 billion, or 21% of revenue, providing the foundational, high-margin crude oil cash flow. The integrated liquefied natural gas segment produces $25 billion, representing 11% of revenue. Finally, the integrated power segment, their rapidly growing electricity and renewables division, adds $10 billion, or 5% of total revenue. Geographically, TotalEnergies is an even bigger master of diversification. Europe remains its largest market, generating $93 billion, or 43% of total revenue. The rest of the world and Asia segment contributes $75 billion, accounting for 34%. North America provides $28 billion, or 13%, while their historical stronghold in Africa brings in $22 billion, representing the final 10%. When you benchmark this operational engine against competitors, a distinct advantage emerges. Chevron and ExxonMobil are heavily weighted toward the Americas and traditional fossil extraction. Shell matches Total in liquefied natural gas, but BP has struggled to balance its green ambitions with its legacy assets. TotalEnergies has managed to build a highly profitable renewables arm without sacrificing the ruthless efficiency of its traditional oil and gas revenues. Now, we enter the forensic deep dive, looking past the top-line revenue to the metrics that dictate true corporate survival. The balance sheet of TotalEnergies is an absolute fortress. The company currently carries a net debt of approximately $20 billion. While that figure sounds immense to the retail investor, for a super major, it is exceptionally conservative. Their net debt to EBITDA ratio sits at a phenomenal 0.5, meaning they could pay off all their net debt with just 6 months of core earnings. Their interest coverage ratio is a massive 15 times, indicating that their operating profit covers their debt interest obligations 15 times over. Higher interest rates are simply not a threat to this company. Their operating margin stands at a highly efficient 14%, and their free cash flow margin is an outstanding 10%. Let us examine the compound annual growth rates to understand their long-term trajectory. Over the last 5 years, their revenue CAGR is 2.4%. Over the last 10 years, the revenue CAGR is negative 1.2%, a lingering mathematical echo of the brutal 2014 commodity crash that reset the entire sector. However, over a 25-year horizon, the revenue CAGR is a steady 4.1%. But as dividend investors, we care about the cash left over after the factories are built and the wells are drilled. The free cash flow growth is spectacular. The 5-year free cash flow CAGR is an explosive 18.5%. The 10-year free cash flow CAGR is 8.3%. The 25-year free cash flow CAGR, which includes multiple devastating economic recessions, the global financial crisis, and the pandemic, stands at a highly resilient 6.2%. They are structurally printing more cash today than at any point in their century-long history. This monumental cash generation fuels the primary objective of our analysis, the dividend fortress. TotalEnergies has cultivated a reputation for fiercely protecting its shareholder distributions. The current absolute payout is roughly 3.01 euros per share annually, translating to about $3.25 on the American depository receipt. This provides investors with a very attractive current dividend yield of approximately 4.8%. The safety of this yield is unquestionable. Their payout ratio, calculated strictly against free cash flow rather than easily manipulated accounting earnings, is an incredibly low 25%. This leaves billions of dollars on the table for debt reduction, acquisitions, and alternative shareholder returns. Let us review the dividend CAGRs. The 5-year dividend CAGR is a reliable 4.5%. The 10-year dividend CAGR is lower, sitting at 2.1%, reflecting the immense discipline required to maintain the payout during the 2020 pandemic, when oil prices briefly turned negative. The 25-year dividend CAGR is a robust 4.8%, slightly outpacing historical inflation. But we must look at the total shareholder yield. Over the past 5 years, TotalEnergies has aggressively weaponized its balance sheet, delivering an average buyback yield of 3.8%. Over the past 10 years, the average buyback yield was 1.5%. They are systematically retiring shares, instantly increasing your ownership stake, without you having to deploy an extra cent. Compare this policy to BP, which permanently impaired its dividend during the pandemic, or to ExxonMobil, which had to take on massive debt to protect its aristocrat status. TotalEnergies offers a higher starting yield than the American majors, supported by a payout ratio so low that it virtually guarantees future dividend hikes regardless of mild commodity fluctuations. No equity is without risk, and the threats facing this European giant are complex. The geopolitical landscape is a minefield. Following the invasion of Ukraine, TotalEnergies was forced to initiate a painful multi-billion-dollar write-down of its massive Russian natural gas assets, severing ties with a region that had been central to its growth strategy. Furthermore, being headquartered in France exposes the company to the constant threat of European windfall profit taxes, where governments attempt to confiscate excess cash flow to subsidize consumer energy bills. But history provides a parallel for survival. In the 1970s, the nationalization of oil assets across the Middle East threatened to bankrupt the European majors. Total survived by relentlessly pivoting to the North Sea and deep-water Africa. Today, they are surviving the loss of Russia by pivoting to American liquefied natural gas and offshore assets in South America. The technological risk of the energy transition is also being mitigated through sheer financial force. Their forward guidance is crystal clear. Management projects a 2 to 3% annual production growth over the next 1 to 3 years, heavily weighted toward high-margin liquefied natural gas. More importantly, they have provided forward guidance projecting an additional $4 billion of structural free cash flow growth by 2028. They are not fighting the green transition. They are funding it with crude oil and ensuring they own the electrical grid of tomorrow. In 1999, Total executed a ruthless €14 billion hostile takeover of Elf Aquitaine. The French government initially opposed it, competitors were terrified by it, and the financial press called it overly aggressive. But that €14 billion gamble is exactly what created the insurmountable scale, the deep water expertise, and the massive cash flow engine that protects your dividend today. Without that hostile takeover, Total would have been swallowed by an American competitor decades ago. Instead, it became the predator. TotalEnergies is not a speculative growth stock. It is a foundational income-producing asset that acts as a hedge against inflation and energy scarcity. The CASJ verdict on TotalEnergies is an unconditional core holding for a global income portfolio. We assess the current valuation through the free cash flow to enterprise value yield, which currently sits at massive 12%, signaling deep undervaluation relative to the American peers. Based on the technical analysis of the weekly chart, the stock has established a multi-year channel of higher lows, consistently finding aggressive institutional buying pressure at its 200-week moving average. Our ideal buyer's entry price range is between 58 and 62 euros on the Paris exchange, or between $63 and $68 on the American depository receipt. Acquiring shares in this specific zone locks in a premium yield approaching 5%, while securing a profound margin of safety. Thank you for listening to this archive. I'm Cash, and this was CASJ Global Dividend Intelligence. Stop guessing. Start knowing.